Welcome to another Rogue Trading Communities video. This video is gonna be one of the most mind-blowing videos that you have ever seen in the history of trading because I'm gonna clearly explain how to use volumes the right way, because this is a mistake that I have been seeing from a lot of viewers have been applying. In fact, I have made a lot of content related to volume spread analysis, but still a lot of viewers are actually applying volume in the wrong way. Well, watch this video until the end, and trust me, after this video your vision will change completely in terms of volume. Okay, now let's get started. But before that, if you're new to the channel, then please watch the videos related to volume spread analysis which has already been uploaded in our channel, so that you get an idea what we are talking about in this video. If you don't know about it, all you have to do is go to the Rogue Trading Communities channel. Okay, I'm going to leave the link in the description. Okay, go to the playlist section. Okay, all you have to do is go to the playlist section and click on the volume spread analysis signals and concepts playlist. Okay, I have uploaded n number of videos right here. Please go through all the videos and you're gonna get a clear-cut idea about volume spread analysis. Okay, so once you watch that, this video will make sense for you. Okay, but if you're already a viewer from our channel, if you already know volume spread analysis, then you can continue from this video. Okay, now let's get started. Now, when we talk about volumes, you have to understand, are we using volumes the right way? Right? Now, what do I mean by that? Well, market, when we talk about market, right, when we talk about the chart, where you see a trading view chart out there, obviously in this particular case, market momentum, when you talk about the price momentum, let's first talk about price, because price is a very important element. It indicates value of a certain financial instrument out there. Now, when we talk about price, the price is not random actually, right? Price is not random. It doesn't create a random momentum actually, right? It does create random momentum in a certain interval, but not completely, right? It creates proper higher high, higher low, higher high, higher low, higher high structure. Okay, and it creates some sort of a horizontal structure also, right? It creates some sort of a horizontal structure where market goes sideways, and this is where the randomness is available right here. Okay, this is where the randomness is, but most of the times market either creates higher high, higher low structure or lower high, lower low structure. So that's how the market creates, right? I've already explained in n number of videos related to this. So please go ahead and watch this video. If you don't know about market structure, well, I'm going to explain in this video, but I have explained it in detail in these videos. Okay, so I would recommend you guys to watch multiple time frame analysis part 1. Okay, and then the another video which I would recommend is the understanding the basics, the 4 phases of the market. Okay, I've explained the very basics of market structure in this videos, so please go ahead and watch it if you don't know about market structure in depth. But we're going to revise it right now. Okay, so what is the basics of market structure? First, we have to understand this before applying volume. Okay, now when we talk about market structure, as I explained, market creates a proper momentum, like such as I've given an uptrend example right here. Okay, in an uptrend, it creates a proper higher high, higher low structure, right? Simple. And as you can see, I have given an example right here. This is one of the stock 1 hour time frame. Okay, see, clear cut higher high, higher low structure has been built right now. Just by looking at this chart, you can recognize this as an uptrend, right? And when we talk about a downtrend creates a lower high, lower low structure, right? Simple. And as I explained, I have already given an example right here. So you can check right now, lower highs, lower lows has been built right here, and market creating a clear cut downtrend right here. Complete. Now, when we talk about the basic market structure in terms of recognizing these higher high and higher low, we usually recognize it in the form of impulse and correctives. Now, what do I mean by impulse and correctives? From higher low to higher high, the momentum, the higher high momentum in an uptrend is called an impulse. From higher high to higher low is called a corrective actually. Okay, so please understand this. I've explained this in depth in multiple time frame analysis 1. So please go ahead and watch it. Okay, but this is just an idea as of now. Okay, now when we talk about downtrend also, the lower high to lower low is considered as an impulse. From lower low to lower high is considered as a corrective, and this cycle continues actually. Okay, now when we talk about impulse and correctives, right? Obviously, you have impulse, you have correctives. That's something that we got to know about it at this point of time. But even when I talk about impulses, usually impulses is one way where market creates that momentum towards the lower side actually. It might be having fractals of impulse and correctives, but usually it just creates that one momentum, right? It just creates that one momentum towards the lower side. That is as clear as that, right? So we understood that. Now, when we talk about impulse, it's usually one way, but when we talk about a corrective, there are types of correctives actually. And this is also, I have already explained it, but if you want an idea, there are two types of correctives. One is an angular corrective, right? So when market creates that higher high momentum, it creates a higher high to higher low momentum. That is what you call a angular corrective. Some people call it usually a one leg corrective and so on, right? But usually this is how the case is. Okay, it's an angular corrective. Okay, the another type of corrective which we talk about is a horizontal corrective, a sideways momentum. You might be seeing where market creates a momentum and then goes on a ranging market actually, right? It creates a range where price bounces from the resistance and support eventually, and then later on it creates a momentum towards the higher side or a lower side depending upon the market scenario, right? So that is what a horizontal corrective. Now if you know about these things, then you are you already know the basics of market structure, right? Simple. Now once we know the basics of market structure, now the volume gets into it in the role play. Now what do I mean by that? I have already made videos about signal of weakness in volume spread analysis, signal of strength in volume spread analysis. I have made n number of videos about cause versus effect, effort versus result and so on, right? Now we have to apply volume spread analysis with the market structure. Now what do I mean by that? Let me show you that with an example right now. So now we have an example of Apple stock from Nasdaq. Okay, this is a 1 minute time frame, and as you can see, market is creating a downtrend momentum, clear cut lower high lower low momentum, right? As you can see, and if I start recognizing these things right here, let's say from here this point onwards, from the up to this point, you can consider this as from lower high to lower low. Okay, from lower low, market created a horizontal corrective. Okay, from after a horizontal corrective, market broke at this section. Okay, so this is your maximum level where market created that up move. Even in a horizontal corrective, from this point market went down right here. So this will be your new lower high, and this will be a new lower low, and from lower low market created a lower high, and then further created a down move from this point onwards, a clear cut downtrend as we are observing right here. Right now, the first step to apply the volume is not to look at the volume actually. The first step is to recognize market structure and then apply volume with the market structure. Now what do I mean by that? You guys already know the concept of signal of weakness and strength, and let's get started with it. I already told you, you have to watch volume spread analysis videos like selling climax, stopping volumes and so on, and then later on you have to come back to this video. Okay, now as market is creating a momentum from lower high to lower low, this is an impulse of a downtrend, clear cut. This is an impulse of a downtrend. So a signal of strength in volume spread analysis occurs on an impulse of a downtrend. Write it down somewhere if you want it. Okay, a signal of strength in volume spread analysis occurs on an impulse of a downtrend. Now what do I mean by that? Observe carefully. This is a down move. Exactly when market is creating a lower low momentum, you are getting that high, see this high volume activity. Where you are getting this high volume activity? On an impulse of a down move, right? Impulse of a down move, clear cut. You got one more high volume activity right here, exactly on a impulse itself actually. From this point to this point is your impulse, right? Market is creating a down move. Even here in this section, you got a high volume activity, and this I have applied a moving average of 30 on volume actually. Okay, we have to determine which is a high volume activity, which is a low volume activity. For that, I have taken moving average of 30 right here. Okay, and as you can see right here, even in this particular case, you got a high volume activity right here. Okay, so from this point market started, and we are counting from that point. Okay, so as market is creating a lower low momentum, you are getting a high volume activity in a down bar. That is considered to be a signal of strength, And now when we understand signal of strength, what does a signal of strength indicate? A signal of strength indicates that slowly market is creating buy orders right here, where buyers are slowly entering the market right here. That's what a signal of strength indicates. But it doesn't mean that this is a complete reversal. You'll get a reversal right here. No. Please understand that this is a cycle of the market. If you get an impulse, you'll get a corrective. If let's say there are more buyers, it will create some sort of a reversal sign, and then it will create further momentum. We will talk about reversals in the upcoming day. But right now you have to understand, just because market is creating a lower low momentum, just because there is a strength is being built in the market, doesn't mean that market will reverse. It is just that if you are getting a strength in an impulse, it means that the impulse has the potential to end and a corrective will begin. And what do I mean? After an impulse, you will get a corrective. This corrective will begin. That's what this particular high volume activity is indicated. Okay. Please understand these things. And now in a corrective, let's observe this thing in a corrective also. Now here, observe carefully. Here, what kind of corrective it is? Is it an angular corrective or a horizontal corrective? This is a horizontal corrective, right? Clear cut? Now when we talk about a horizontal corrective, as I told you, this is a random area where it creates random highs and random lows. This can be random actually. Okay, you don't have to worry about it. This is a random area, and whatever the high volume activities and low volume activities you get in a random area, usually they are random volumes also. Now what do I mean by that? As you know that if sellers are dominating, market will create a down move. If buyers are dominating, market will create an up move. But what if both buyers and sellers are not dominating right here? Right? What if both buyers and sellers are not dominating right here? Market will create a sideways market. And in a sideways market, both buyers and sellers will exist. Constantly someone is buying, constantly someone is selling. This activity goes on. That is the ultimate reason where the volume that is in a sideways market is always random actually. Okay, but even in that volume, if you observe carefully, as market created a down move, you got a strength built and market went up, right? And as market is creating an up move, you got weakness built, market went down. Look how beautifully these things are, right? See here, again strength got built up at this case, this volume right here, right? Market went up right here. Even weakness got built again, then market went into a sideways and market went down right here. Again strength got built, market went up right here. Strength and weaknesses constantly play with each other. Strength indicates buyers are entering the market, weakness indicates sellers are entering the market. And this is something that you have to apply with the market structure itself. And then only it will make sense. Think about it. An impulse, a horizontal corrective, and again market started creating an impulse, and as market is creating that impulse from the lower high to lower low, see slowly strength is being built in the market. All the high volume activities are strength right here. What does that indicates? That this impulse could end at some point of time and a corrective would start. And see, I'll show you something. This is a corrective, an angular corrective in a downtrend. This was a horizontal corrective in a downtrend. This is an angular corrective on a downtrend, right? And observe carefully. As market is creating that angular corrective from lower low to lower high, you are getting weakness being built in the market slowly. Look. And what happened after that? After once market had this weakness, market was sustained a little bit and started falling down right here. I hope you're getting an idea of how to read the volumes right now. You have to read the volumes with the market structure itself. Okay. Now I'll give you one more example with bar chart itself actually. Okay, let's do it because I have explained VSA in a bar chart. Okay, and a lot of people ask me this question that, sir, why can't we use candlesticks while we are trading? Let me tell you that personally, even I use candlesticks, but I just keep my candlesticks and bar chart together in my favorites. If you see in the top side right here, you see, I keep my candlesticks and bar chart on my favorite. So I can, within one click, I can know what's happening with bar chart and candlesticks also. I'm familiar with both of them. Okay, but at the end of the day, please understand, it doesn't matter if you're trading with bar chart or candlesticks, both are price. It just indicates high, low, close. That's it, nothing else. So you have to understand it like that. Okay, now, as you can see, this is Nifty's futures chart, a 5-minute time frame. and market is creating a clear-cut downtrend right here. It created a gap down and started creating a lower low momentum. Now we are going to apply volume spread analysis as per the default method. Now what do I mean by default? We learned volume spread analysis in a bar chart. We're going to apply volume spread analysis in a bar itself right now, just for the clarification. Okay. Now see, what kind of signal do you think this is? Can we say that this is a down bar, a widespread bar with a ultra high volume activity? Can we consider this as a selling climax? Yes, this is a selling climax. Now once we get a selling climax right here, it is an indication of strength being built in the market. Now when you know that selling climax is a signal of strength, people have this misunderstanding that after you getting a selling climax, market will reverse from this point. Did you get a reversal right here? No. But what did you get right here? This was your lower low momentum that indicated that the impulse phase will end and a corrective phase will begin. That is what a selling climax indicated right here. And see what happened. You got an angular corrective right here. And then after that, observe carefully, at the end of this angular corrective, you're getting this bar right here. What does this indicate? A high volume activity at the end of a corrective. That is indicating weakness in the market in the form of a buying climax. It might not be a widespread bar, but still it is a high volume activity. And please understand, high volume activities cannot be created by retail traders. High volume activities can be created only by smart money activity. If there is a high volume activity, there is a reason behind it. And you shouldn't ignore any high volume activity out there. Okay. Now, as you see, you got weakness while market is creating that up move. Okay. And then further, after that up move, what happened? Market started creating a lower low momentum. Let me show you one more extra confirmation whether this is an authentic, angular corrective or not. If you observe carefully here, this bar, a volume lesser than the previous two bar, followed by a confirmation bar. What kind of bar do you think this is? Does it look like a no demand bar? And what does a no demand bar indicates? I've already explained it multiple times. A no demand bar indicates that there is no demand in the market. Buyers are not present at this point of time. So the probability of sellers entering the market is higher. And look what happened exactly from that point. Market drastically fell down. And at the end of this lower low momentum also, you're getting strength. So one could easily take a trade at this section and capture this momentum. And as soon as they are getting strength being built in the market, you could book your profit exactly at this point. And this is how even we trade. This is how we trade in the community. But there are other confirmations also. Trading is all about adding more filters actually. Okay, please understand this. Trading is all about adding more filters. First, you have to understand the base knowledge, that is market structure and volume spread analysis. And then top of that, if you're adding indicators, it's absolutely great. But you have to add multiple confirmations that improves your confidence as a trader to execute a trade. Because you are spending your hard-earned money right here. You don't want to lose your money. If you don't want to lose your money, please first understand the market, then apply trading in the right way. Okay. So I hope you're getting an idea right now. See, you got strength being built in the market at the end of an impulse. And see, market started reversing from this point. Right. And see, even here, you got a weakness right here. Then later on, market fell down right here after that point of time. That's what it is. I haven't showed it right here, but I've just taken an example right here. That's how you have to read the volumes. So that's it for this video. I hope you got an idea about how to apply volume with the market structure right now. And as you know, in uptrend, this is just a vice versa. Okay, I have explained it in a downtrend. Okay, I've explained the impulse and how to apply volume with an impulse and correctives of a downtrend, and same goes for an uptrend also, right? When uptrend is creating a momentum, you have to first recognize market structure, and with that you have to apply the signal of weakness and strength. Whereas in an uptrend, weakness gets built on an impulse and strength gets built on a corrective actually. Okay, so it's just the same principle, nothing much. Okay, so I hope you got an idea, but there are a lot of things that we can add in this thing. Okay, to make it easier, we're going to make more videos about this particular topic. Okay, so yeah, we'll see you in the next videos. Goodbye and have a great day.